from 0 to 5 days of days, okay, 5 days, 10 days, 15 days, 20 days, 25 days. It repeats the same calculation throughout the same throughout the data set, and then it plots the graph. I know it's a bit complicated to understand this. It's called lagged observation. Anyway, what I recommend you to do, don't try to understand this. This is just time, okay? Just imagine that in the 2007-2010 time frame, this is what happened. It doesn't matter what's you know. We're used to look at charts in this way, okay? From the left until right, you have to look at the chart in this way. Okay, sorry for the show. Okay, here is, for instance, that's another way. This is 2007, okay? Our time frame is 2007, 2010. This is 2007, okay? When a positive news hit the market, the volatility rose until here, okay? When there was a negative shock hitting the market, volatility rose in this way, okay? Here 2007, here 2010, here 2010. All right, sorry for not making that clear.
It's not it's only 25 days or either side.
It recalculates that all the time. For all that's why they are called lagged observation, but it's the entire data set. Otherwise, I cannot really show you the volatility over only 25 days if I'm using 3 years data.
Take an average of those 25 days.
That's what the model do, yeah, that's what the model does, okay? So just imagine here 2007, here is 2010, and here is 2010. I know it's a bit complicated, guys, if you're not familiar with this, because it's something that I spent quite a lot of time on, and it takes time to understand these things, but that's the way in which the market works, at least in these days. So this is what used to happen over the last 10 years. As you can see, volatility used to rise more when positive news were hitting the market. So investors were more confident in the market. What about the conclusion? The analyzed market presents strong evidence of leverage effect processes. Once again, when the returns drop, volatility tends to rise quite a lot in all this market. The financial crisis reshaped many markets that were usually considered not to be leveraged, such as currency markets not leveraged at all. Crude oil market wasn't considered to be leveraged. Gold market or commodity markets in general. Leverage, it means these markets are very difficult to manipulate. Okay, this is what leverage in this sense mean. Okay, these markets were considered to be very difficult to manipulate, because as we know, in commodity markets, mainly the 80% of the players are commercials and not really retail traders. So they move a lot of money, so they are very difficult to manipulate this market. So the financial crisis reshaped literally the market, because now the currency markets, as we recently saw for the euro dollar, now is leveraged when it used not to be. In leveraged market, returns drop much more quickly than normal in normal markets. I said normal in brackets because basically it's in normal trading conditions. Asymmetric volatility can be used to scale trades and reinforce short or long positions. That's what we were talking about a few minutes ago. When if you know that you're trading a leveraged market, when there's a negative shock hitting the market, obviously you can reinforce much more your position. Obviously, be careful. This is not the holy grail of finance. This is just some econometric calculation that have been done. Otherwise, it would already be rich. And asymmetric volatility is often used in options and future strategies, both for speculating and hedging purposes. How they use it, we will see that later on. Any question? Thank you very much.